All right, let's jump right in. Today we're tackling a massive question. How can a war happening thousands of miles away have a real, direct impact on the Indian economy? And yeah, even on your wallet. We're going to connect the dots between global conflict, oil prices, and your portfolio.
I mean, it sounds a little crazy, doesn't it? A military event way over there, and suddenly the petrol and even the Dow you buy right here costs more. But trust me, it's not a mystery. It's a chain reaction, and today, we're going to trace every single link in that chain.
And here's the good news. This whole complex web of global events can actually be boiled down to something much simpler. When a distant war sends shockwaves our way, they pretty much always travel through three main channels.
So what are they? First, and this is the most obvious one, commodity prices, especially oil, they just go haywire. Second, investors get nervous, they get scared, and that changes how they behave. We call that a shift in sentiment. And third, these conflicts often lead to sanctions and actual physical disruptions to trade. These are the three big forces we're going to be tracking.
Now, before we zoom in specifically on India, we need to understand the global template. Because what we're seeing today, it has happened before and it almost always follows a predictable pattern.
Just look at the Russia-Ukraine war. It's a perfect, really recent case study. You saw commodity prices shoot through the roof, which pushed global inflation way up. That soured investor sentiment, which triggered major sell-offs in the stock market. And where did all that money go? It ran for safety, to assets like gold. The impact was huge. The OECD and World Bank figured it cut global growth by over 1%.
Okay, so with that blueprint in mind, let's focus on the specific situation that's all over the headlines right now. This is the crisis we really need to break down to understand what it means for India.
So the conflict itself might be centered on Iran, but the real economic fear, it's all about this tiny strip of water, the Strait of Hormuz. A massive chunk of the world's oil that travels by sea has to pass through this one narrow channel. So you can imagine, any disruption here is a huge deal for the world's energy supply.
And this isn't just theory. Analysts have already put a number on the immediate risk. This commentary makes it crystal clear. Even a small disruption could mean a $10 to $12 jump in oil prices just like that. A really serious threat to the strait could easily send crude well over $100 a barrel.
So here's the billion-dollar question. How does that $100 barrel of oil in the Middle East actually make its presence felt here in India? Let's trace that ripple effect as it hits our economy. You know, I find this is the absolute clearest way to think about it. Now, it's not a literal tax, of course, but for the economy, it functions in exactly the same way. See, India imports most of its oil, so when the price spikes, it just sucks money out of our economy, and that slows everything down.
And we can get even more specific than that. There's a rule of thumb that economists and market watchers use all the time. Let's take a look at what happens every single time the price of crude oil goes up by a sustained $10.
Now, this is what's really fascinating. This table basically quantifies the pain. For every sustained $10 hike in oil, our GDP growth gets shaved by about 1/4%. The inflation that you feel every day goes up, and our nation's import-export balance, what we call the current account deficit, it gets worse by a whopping $12.5 billion.
Of course, this is not the first time India has had to deal with this kind of shock. So let's look back and see what lessons history has for us, because the patterns are, well, they're incredibly revealing.
Just look at this timeline for a second. The outcomes are all over the place. In 1990, the Gulf War helped trigger a deep economic crisis for India. But then, in 1999, during the Kargil War, the market actually rallied. More recently, you had the big shock from the Russia-Ukraine conflict, but then the market was surprisingly resilient during the Israel-Hamas war. So what gives? Why the huge difference?
Well, the key takeaway is that context is everything. The 1990 Gulf War hit an Indian economy that was already incredibly fragile, and it just pushed it over the edge. But in 1999, the cargo conflict was seen as very limited, and on top of that, our markets were already booming thanks to a global tech bubble. The point is, the state of our own economy matters just as much as the war itself.
And through all this turmoil, there's one asset that tends to be a reliable performer. You guessed it, gold. Look at the data here. Now, the initial jump in the first week might look pretty small, but look at the average gain over the next 12 months, almost 9%. It is the classic flight to safety, playing out time and time again.
Okay, so what do we do with all this information? This final section is all about building a mental framework, a way to think, to help navigate all this uncertainty. And just to be clear, this is a way to approach the problem, not direct financial advice. We can kind of game out three potential paths from here.
You have a moderate scenario where oil just kind of stays elevated in the 90s. Then there's a severe scenario where a real supply disruption pushes oil north of $100. And of course, there's the optimistic case, a quick de-escalation where this whole price spike just reverses itself.
And this breakdown really shows that the impact isn't the same for everybody. Companies that use a ton of fuel, think airlines, paints, cement, they are going to feel the pressure. But on the flip side, upstream oil producers could actually benefit, and exporters in sectors like IT and pharma might get a boost from a weaker rupee.
So, what should you actually be watching? Think of this as your personal dashboard. Obviously, keep a close eye on crude prices and any news from the Strait of Hormuz, but you also want to watch our own inflation data, the rupee-dollar rate, and a big one. Are foreign investors putting money into India, or are they taking it out?
So let's bring it all together into a practical game plan. History suggests that we need to separate the short-term panic from the long-term story of the Indian economy. In the past, these corrections have often turned out to be buying opportunities. Having some gold can act as a good hedge, and finally, pay just as much attention to how the RBI and the government are responding as you do to the war headlines.
And all of this leaves us with one final big-picture question. After everything we've seen from Ukraine to the Middle East and the clear, quantifiable impact it has on our economy, you really have to ask yourself, is this kind of geopolitical risk just a permanent feature of investing now? Is this the new normal? Something to think about. Thanks for tuning in.